Emil, you read the letter. What do you think? Is this a CEO trying to get ahead of what's going on in the markets, or is it one that's trying to catch up?
I mean, it's definitely one trying to catch up. I mean, if you look last month, GoPuff, Robinhood, Meta all did layoffs or hiring freezes, anticipating this market climate. And I think what's most important, if you looked at Airbnb's earnings last week, they already talked about free cash flow. So this notion of adjusted EBITDA being a new thing that's not in favor isn't right. I think the market has been telling us for 4 months now that they're going to be more focused on free cash flow and profits and profitable growth.
Yeah, Emil, I've noted that DoorDash has already had 2 years of free cash flow profitability. But you bring up some of the other companies like GoPuff and Robinhood. I mean, they use these different metrics as well. They're still using them. Could you give Dara Khosrowshahi credit for at least coming out and saying we're not going to use this anymore? I haven't really heard that from other companies that use it.
Yeah, I think that's smart to do. I mean, I think it was smart from the beginning. It's smart now because ultimately that's how companies are going to be valued in the long run, whether in bull markets or bear markets. It seems like the market just got ahead of itself in 2020 and 21, and we're focused on, not the real true financial metrics. And you, Deirdre, have been pushing on that for years too. And I think he does deserve credit for that.
Are you pushing some of the companies that you're invested in, Emil, to start looking at those metrics? What are you telling them that the market's demanding different things, especially a company like GoPuff, which is an IPO candidate, and it's going to be tough for them?
Absolutely. I mean, when I started to feel this way in early February, when we started to see real declines in how the market was valuing these high growth companies that were burning a lot of cash. And my message to them was, do it sooner rather than later. Look hard at your infrastructure, your cost structure. Make sure that everything you do from a unit economic standpoint is going to be profitable. And really ring the bell on that, making sure your balance sheet is fortressed and so on. And I think you're going to see a ton more of that in the next 60 days.
Right. We'll see. Emil, final question. What is the disconnect, do you think, between what Wall Street thinks Uber is worth and where it's trading? Have to note that 80% of analysts on FactSet rated a buy mean price target of $50, more than half where it is now. Where's the disconnect?
You know, it's funny to me. I think when you hear Uber management, they talk about Wall Street doesn't understand us. Wall Street doesn't understand us. The company's been public for 3 years. They had a big analyst day. Wall Street understands the company. And, it's sort of like we're in a relationship and you break up and it's like, it's not me, it's you. Well, maybe it's you. Maybe the company needs to do things better. They lost a lot of market share to DoorDash over the years. In rides in both Europe and in India, in Eats in Mexico. I mean, losses across the board. So I do think investors look at that and they say, hey, that's great that the analyst says that. But what I'm seeing is market share losses in the data from credit card data that's being published all over. So I just think the disconnect is really in management, not inside the investor.
Well, shares down nearly 7% today. Emil Michael, thanks very much. Talk to you again soon.
All right, bye-bye.